Welcome everyone to another Quantium Research live stream. I'm your host Ryan Kia of quantiumresearch.co.uk and now Quantium Research Limited. And we are going to look through some ideas as we normally do. Wonderful. Got a nice hot chocolate in front of me. Something to give me a bit of energy. This is probably going to be a 30-minute session max, where we look through some stuff. Nothing too intense. I want to get some value out of this 30 minutes though. One that I'm a little bit shocked about is Alibaba popping. And you probably will have noticed that we closed AO at 405 literally just yesterday, and it was 434 on the highs of the day. That's basically pegging on new all-time highs. So I do look like a total fool, and I will accept that I made a mistake. I think I acted a little bit too prematurely in terms of closing for an invalidation, because by the end of the day, the setup was maintained. I refused to get involved again unless it was lower. And guess what? I lost out on probably double what I could have made. But oh well, that is the game. I'm going to pull out chat separately here. And then get some charts up in the background. Alright, ticker symbol. We've got a couple new ones. Oh, before we do any of that, S-Wave. This is one that we were looking for. Lockdown livestream, welcome and hello everyone. Welcome TradingView, how you doing? This is one that's popped today that was on our watch list for new all-time highs. Yesterday it maintaining above 140 meant I could have ICE allocation, but not on this account. It didn't make sense. I'd be too exposed. But that's going to be running, which is smooth. We looked over a couple of UK housing real estate investment trusts as well. Last stream, we had Unite Group, which right now is experiencing a strike from a lot of students, and that means that they may lose again to the sum of, who knows, maybe not 70 million, but they may not make money is the thing. If they get a rent reduction, administrative expenses don't reduce, but then revenues do. Imagine everything stays the same. The company goes from normally making a profit as a real estate investment trust to either not making anything at all, or not even losing anything, or making a loss, which is something we have to consider. And it's interesting how these three large real estate investment trusts in the UK, all to do with student housing. Unite Group's worth about £4 billion. GCP is worth about 650 million. And Empiric Student Property at 450 million. You can see they move quite similarly. This is a daily chart. Each candle represents a day of trading activity. You see that? Once again from the beginning, UTG, DIGS, and ESP. But then look at CSH. There's a bit of a difference. And the irony is, in the fundamental sense of CSH, aka Civitas Social Housing, is in the name. It's a social housing real estate investment trust. So these guys can get rental income from the government, and that income is indexed. It says here annual indexation if I dive into one of their documents. I personally hold CSH. They're not like a huge return kind of thing or anything. It's just a bit of asset allocation in action. Now, oh, what is that? That is an email that I'm going to cancel the notifications of. But nonetheless, this housing, should I say, real estate investment trust itself works in a way where it pays a quarterly dividend of 1.3 pence, 1.35 now, pence per quarter, and that's per share. So right now trading at 105.2. The yield, oh, it even says it here on TradingView. That's great. I was going to say roughly 5%, 5.15%. That's quite nice, because think about it. If you can't afford to buy a property and have exposure to properties by investing in them, then a smarter option would to be getting exposure to properties through a real estate investment trust. And CSH is an example. Whilst it doesn't look here that they've had capital growth, if we kind of zoom out a little bit, they've had somewhat of capital gains. Nothing huge, but think about it. If you make 15% plus over that period, you can get what, 4 dividends? That's roughly 5 pence, 5%, 20%, and 20% over a period of. This is quite a bad thing to look at, actually. But let's say a year. Not huge, but no bank account right now does anywhere near that. I can't see bank accounts that do more than 1%, considering the low interest rate that is there right now. So this one is one that I like to hold, and not from a technical perspective as well. We'd be getting long above 108 just as a bit of clarity, and then try 115 or so. But the dividend things, what I like, it doesn't tend to move as much in the downwards direction as that dividend supposedly is. Hey Chip, how you doing, man? I saw your video the other day. I think it was episode 4. Really cool. I didn't know that you could actually add the market caps of a couple of things. I think it was Facebook, Microsoft, and all those big guys. Another crazy one. Boom. Alibaba. This is what's on everyone's mind right now. I have some financials notes that I briefly touched upon on a recent stream. Let me pull that up. Don't mind this box, it's very old, but I keep it as reference. So, I'm going to do some calculations in dollar terms for Alibaba. You can see the market cap here is 616 billion. I think I had it as a little bit more, 240. I'm not sure if there's a deviation. But 650 billion, let's assume, to be the market capitalization. Otherwise, the total value of this company. And we're looking at their US listing, bear in mind, NYSE, not the HK share listing. That's 220 something yen, I'm not sure. But anyways, revenue for 2019, that's sales, accounted to $56 billion, roughly, right? In 2020, the year after, it's estimated to be around 73 billion or so, but when the full reporting period comes in, could be anywhere up to 83 billion. But still, these are just some figures. Look at that growth: 56 billion in 2019 to 73 billion in 2020, and a 2021 full year revenue forecast of $108 billion. And this is dollars. This is crazy, right? That's not too expensive if we think about 12-month forward revenues versus the market cap, 6 times sales. Not much of an issue for a company in this space, especially at the fact that 2022 revenue estimations are 141 billion. But the problem is, you think revenues, oh, tech companies always lose money, and that's why they're growing revenues and all that. Well, the thing is, with Alibaba and also their main competitor, Tencent, these guys are highly profitable businesses. The problem with Alibaba is that they're not very diversified. Alibaba, I think 80% or so of its revenues come from one area, e-commerce in China. And their fastest growing segment is from an area that has revenue internationally. And that's their cloud computing segment. That is a beautiful, beautiful thing we'll touch upon shortly. But for now, revenues have grown from 2019 to 2020, $56 billion to $73 billion, let's just say. Lower estimate. And in 2021, they expect to do $108 billion. Now let's look at net incomes. 2019, they made just under $8 billion. 2020, they made just over $17 billion. So that's more than double the year before. In 2021, the estimation is roughly $27 billion. So we're talking decent growth in revenues, if not exponential, to a degree for its size, right? It's not 100% or whatever, but if you can grow 20 billion on 80 billion kind of thing, that's impressive. Now, net incomes are expected to be 27.6 or so billion in 2021, right? So if I do a blended forward price to earnings ratio, which essentially calculates their price to earnings ratio in 12 months time. Let me go to where I've saved that. That works out to be cheaper than most of, if not all, of their competitors in the industry. And the problem is when you're comparing a company of this size to its competitors, it gets put in a list with places like Amazon and Tencent as well. But then you get the smaller ones as well, like JD.com. JD.com, growing revenue well, profitability is nowhere near Alibaba's. Alibaba's expected for next year, net income should be around $27 billion. That's crazy because JD is worth 150 billion versus Alibaba's 650 billion right now. So what? A 4 times difference. JD is 1/4 of what Alibaba's worth, and Alibaba is 4 times what JD.com is worth. But JD.com's making 1/10 in the expected profit, which is nothing special in my opinion. Whilst it's a great growing company, Alibaba is definitely cheap in comparison. But the problem is Alibaba has fallen out of favor with Chinese regulators. Now, that blended forward price earnings ratio I was talking about, when I last calculated it was 18.9 or so, because the share price has risen in the past session. That is about 20 times. Now, let's look at JD. In terms of that blended forward price earnings multiple, JD is trading at 40 times that. So it's double in terms of a relative valuation to what Alibaba is in terms of the 12 months. So the next 12 months of profits, well, let's just say that. Think of that number, the next 12 months of profits, and you get the market cap of Alibaba right now, you divide it by those profits. That's how you calculate the blended forward price to earnings ratio. Now, Alibaba is super cheap in comparison to JD, or the whole sector is expensive and JD is super expensive and Alibaba is somewhat fairly priced. That depends on what your view of this particular sector is. I want to go back to the revenue makeup just after we look at Amazon for one example, right? Amazon is super diversified relative to Alibaba. Their valuation is much higher as well, $1.6 trillion. So what are we talking? 2.25 times or so. Their blended forward price to earnings ratio is 54.3 times. That shows that on this basis of valuation, they're more expensive. But this is very niche. This is simply earnings. There's a chance that Amazon outperforms those earnings expectations and Alibaba underperforms, which is possible considering what's going on with the monopoly investigation into Alibaba's practices. And it's the e-commerce area, which is really worrying considering it's where roughly 80% of revenue comes from. So I'll pull into the segments and then we'll take a little break because I wanted to make sure that this session was a quick 30-minute or so session filled with as much info as we can put. And we'll probably look at some sectors as well. I think tech is an important one to always follow. I've divided a little list, anything from cybersecurity to whatever, really. Exponential technologies, all that stuff. But anyways, right now, whilst we're focusing on Alibaba, Alibaba's core commerce area, that's where basically most of their revenues come from, accounted for 85.6% of their revenues. The year before it was about the same, and the year before that it was about the same too. Now, let's talk revenues in terms of dollars, because I initially put them at yen, but I'll just use an average real quick. You guys can't see this on the screen because I'm using 2 screens, but I thought I'd keep the chart to have context behind my words as opposed to anything else. So I was doing back to my stuff about segments. All right, just a moment. Okay, so in terms of revenue, the commerce arena, let me make sure these are the right numbers before I say them. Okay, in 2019, the core commerce area of Alibaba's business, that's basically where most of their funds come from, generated $48 billion in sales. The next year, it generated, so for 2020, if we're using the numbers we're being given, a rough estimate of forecast, realistic numbers, all that stuff. Oh, it's making some post-market move. But if we use those numbers, the revenues went from, in 2019, 48 billion or so from core commerce, the main part of the business, to roughly 62.6 or so billion in 2020. That accounts for roughly the same amount. Anywhere between 85 and 86% of their total revenue is accounted for by that main segment. It's not really diversified versus the likes of Tencent and co. But when it comes to the cloud computing business, this gets me a little bit excited, because in 2018, 2 billion revenue, 2019, 3.6 billion revenue, 2020, 5.7 billion revenue. And the problem is they're not making money in that segment. But by 2022, if they are, and the revenues are expanding at a similar rate, then that can be accounting for a significant proportion of growth and also existing profits in case anything goes wrong with the core commerce business. And China is ahead of the game. China has been doing this thing. They had a Singles Day event, kind of like we have, on Boxing Day or whatever, or any of those little events that can be used as a tactic to sell more products in the retail sector. Well, what they did was they teamed up with these celebrities or influencers in kind of a how should I say it? Think of a shopping channel, but more of a live stream, Instagram kind of vibe. And they were live streaming what the product is, what it looks like. And they were able to sell many of those at one time from just one click. You're able to literally buy that item that they're talking about. And then they'll switch from that item to another item to another item. And you could see so many sales, apparently, including pre-sales and also sales on the day, orders, all that stuff. For Singles Day alone, that event, Alibaba did $50 billion in sales. Now that is crazy. I'm going to take a break for a second, quick hot chocolate break, and read the chat. But I hope everybody's doing okay. Oh, thank you, TradingView, for the 350 coins. Big love. Also, if anyone from TradingView is still here, where do I go to buy merchandise? Because I'm done using plastic cups. I need to upgrade to TradingView merch. I love this place. Big love. It won't send, but thanks. Welcome back, Personal Ali. Nice to see you here again. I haven't checked on YouTube chat, but I'm just gonna put that in the back in case. Okay. Wow, we were on a roll. Very slick indeed. Big respect to S-Chip, the OG. It seems that Alibaba's doing some pre-market move. You know what am I even doing? I'm going to pull up the 10k PF and get a live quote through there, because we can trade aftermarket on Baba. Ooh. Alright. Yeah, it is. Okay, let me pull up this for you guys. No. Alright. You see that? That's some cool off. What's happening aftermarket? Let's pull up Twitter or something and see. I don't see why they bounced today. I mean, news of Jack Ma laying low should alarm people more than anything. I worry that if a CEO just disappears and is purposely staying low, keeping a low profile, then there's something up. There's something up that we don't know yet. It's kind of reminiscent of the whole, who's Twitter's biggest shareholder at one time, a Saudi wealthy guy that just disappeared. He came back, but he had to give up some of his assets or whatever. One must be wary of what is being given in the news. And below 237, we assume it's still short till these levels. It could bottom here, but I'd like to get them when there's some clear sign of reversal, because Alibaba financially is cheap, and in a Biden administration it's not like that's gonna change much. How low did this go? Pre-market trading is very odd. Post-market and pre-market, whatever the correct term is. Let's have a look in chat real quick. Don't you think you're using way too much indicators? Did you look at crude oil? Hey, efficient trough. I use what suits me best. These allow me to understand momentum, and I rotate them regularly. I use the same colors for the determinants, but I rotate them frequently for the main purpose of my system isn't based off technical analysis. Technical analysis is why sometimes you can see I get a real good price, and maybe sometimes I'll be getting out once something's turning, but also the TA side is turning. It's essentially playing the game. I think if you don't use TA, it's very difficult to make money because you're simply guessing with points of price action. But if you purely use TA itself, then you're likely to lose money, because all it takes is one overnight kind of tail-like event where you end up losing a lot of money, not to your own fault, just because there was some financial stuff, fundamental news going on in the background. And it's very hard to recover from those times. I don't know what's going on with them, but I'm going to check Twitter, because that is the only news feed I like. Ooh, in terms of oil's up like 5% today, isn't it? I haven't been following it entirely, but the whole sector looks cheap if it can hold above 55. I'm talking Brent crude. Hold above 55, linger between 55 and 65. I think Blackstone's CEO or chairman said that 65 is a fair price. Well, obviously everyone says price numbers and all that, and to really value it, you'd need some really intense model. But I wish him all the best anyways. Oh, am I seeing something in chat? My apologies. I should probably leave this open. Well, Jump US 30 says, what do you think about SPX 500? I will probably pull up. Oh, wait. That's not how I type it. US 500. There we go. Well, oh, don't worry about these lines, but look how accurate they were. Goodness me. And this was early on, I'm pretty sure. This was in that first revisit to 319. I had a bad trade here, though, I think. Somewhere. Yeah, not a good history with that one. But let's look. Let's look indeed. As much as it's a volatile one. Well, seasonally speaking, right? The seasonality for the S&P 500 starts to turn a little bit bearish. Not just the S&P 500, but also the NASDAQ, as far as I'm aware. Let me try and pull up what I was referring to. Yeah. Let me find it. Whoa. I just found an old spreadsheet that might be useful here. Let me find it. US 500. Nope. Let's see. Wow. I got distracted for a second with the seasonality overlay. let's see this. Alibaba's seasonally bullish up until March. That's really weird. That normally takes the inverse of US indexes. US down, China up. But overall, US up more than China, and China's still up though, an impressive amount kind of thing. Let me pull up the S&P 500 real quick. I'm just getting on my other screen some more info to back up what I was trying to say earlier. The SPX. And that is SH. Okay. I'm going to put it to 10 years. That's very difficult to read. One sec. Okay, so generally around February is where we tend to see some form of correction. But the index is almost certainly, in terms of that whole 10-year sample at least, the index almost certainly ends up for the year. Aggressive bullish months from, let's see, well, it's kind of obvious, September, December, all that. Let's see anything that stands out. May up until July. Yeah, May till July. So if I'm assuming that the index is going to consolidate or rise a little bit from here, I think we've probably got rises up until up until end of Jan. I think there's some cool down required, but in all honesty, I think we're going straight to 4,000 on the S&P 500. If there's any direction, we're going to have some form of 100-point correction here and there that everyone says is the beginning of a recession, and then the index just rises after that. That seems to be the case almost all the time. Oh, got a couple of... Oh, yeah, you can't see the other screen, don't worry. I'm not allowed to share some of those bits of info because they're a bit too sensitive informations to my system. But nonetheless, this graph can be seen. When did you start trading? Back in 2013. It was July the 11th, 2013. What about yourself, Efficient Truff? Personal Ali says, when you have spare time, check the Secret Mindset channel on YouTube. It's a professor, I think a Japanese guy, trying to explain how to train yourself reading indicators and how to find trends. I think you'll like it, Ryan, if you don't know him already. I think I've heard of that channel, but I haven't heard of it with relation to trading. But look, if you want to understand how indicators work, I've got an idea, right? Boom, check this out. This is the Quantium Research YouTube channel. That's a little plug, isn't it? Boom, I'm going to put it right there in chat. And we've made about 20 videos just on TA. Whilst TA shouldn't be the only thing an investor or a trader uses, especially, investors shouldn't be using it solely. Traders, when you go to crypto, yeah, you can. There's a way to, because there's no fundamental information. But when you're trading companies and all that regularly extends to currency pairs, all sorts of stuff, you should be understanding beyond just the chart. But if you're not using a chart, your points are almost always going to be wrong. There's a lot of luck involved in there. So understand momentum, understand trader sentiment, generally what the market is doing. I thought I was going to sneeze there, so I thought I'd save you guys. the shock. But yeah, this is the channel. In case anybody wants to watch these videos, they're all free and they don't have ads, so take advantage of them whilst they don't have ads. Because at the moment it's not monetized. And here are also some trading videos of the 10k series. Also, of the 10k trading portfolio, where are we at right now? I thought I'm going to take a couple of days off because I've just had way too many winning trades. How much am I making a week? I don't make a set amount a week. I don't think any trader does. Really. And I also work as well. So, yeah. But in terms of the 10k portfolio, right now we're up 760 or so pounds, because I think it was 10,000 pounds and 7 when we started. This has been about a month. We haven't been super active, but you can see that you can build a portfolio without needing to do too much. But we've also made videos on these trades of the beginning, the development, and the end. Efficient trough. How long have you been trading yourself? Normally, that's not something you should be thinking about regularly. How much do you make a week and all that? You know, I think money to me has become something whatever. I can do that, but I don't find it that satisfying. You know, if you're trading, you're not trading solely for the money, because you wouldn't have survived at least say 5 years in this game. The impact it can have on your mental health, the way it restricts you, if you allow it to, restricts you from doing any physical exercise, getting up, making food, cleaning up, taking care of yourself and all that stuff. It's as most things are, something that you can easily addict yourself to and forget about the main goal. So I'll show you guys an example. I was wrong with AO World. I literally got closed out right at the bottom yesterday, and I thought, yep, reversal, boom. And I was so wrong indeed. And I make these mistakes from time to time, but I need to pause and reevaluate, because if I try and chase the trade, yeah, I'd probably make a little bit today, but then I'd end up playing it to the point where I'd lose a lot of money. And that's why I can't get attached. So if I am re-entering these guys, I'm waiting for an amicable pullback that maintains trend, and I'm willing to give up max the profit that I'd made on the trade. Otherwise, I'm not entering. It doesn't matter if it breaks out, 40, 50 points, and I'd be like, oh, I would have made 3-4 times the amount of money. The money doesn't matter. It's playing the price and the valuation at the time. Nothing changed between yesterday and today, except for probably additions in shareholding. And when they sell, that happens. The big instews. Do I think US oil could drop tonight? I'm not too sure. I haven't been following it, but we can have a look if you want. US oil's the cheap one, WTI. I wouldn't say so. That is perfectly healthy price action, and really straight to 54. Oh, well, if we can hold above 49.30, I think it's straight to 54. What do I think of SPDR? Let's have a look. Don't I have... Are you talking about the S&P 500, right? Or are you talking about thinking... Because when I hear SPDR, I think about either the S&P or gold. Can you just double check, maybe clarify which one you're talking about? You're talking about the S&P, yeah? All right. Welcome back, Andre. How you doing, my brother? Congratulations. I remember seeing that real nice tweet a couple weeks back. It's good to see you back here, man. We were talking Alibaba. We were updating how the 10k portfolio is going and how I made a stupid mistake. I was long at 383.5. I closed at 405 yesterday. And look, this is literally the lows of the day. And it's now 425. So we'd have doubled our profit, but, it is what it is. But at the moment, we're at £10,000 and 760 or so. And that means we're up about 7.6%. Nothing huge, but about a month of action. It's money at the end of the day. And we haven't been too active. The problem is I've had, not only on my personal account, but also this 10K portfolio, I've had like 6 or 7 trades in a row. And normally that doesn't happen. I don't know why. My system hasn't changed significantly. I've just refined a few bits in the past 6 months. I'm due to do my reviews over the next couple of weeks. But it was the reason why I want to kind of take a couple of days off is to cool down. You know, when you have so many good trades in a row, it rarely happens. You know what I'm talking about. You just need to take a break from the market. Like, I went straight by the Bank of England Museum today. I sat down. I had a nice day walking around. I was also distributing some of these bags for, you know, the fundraiser, which a lot of people in our community were helping with. I put masks, tissue things. Let me show you. Let me show you how it looks. Kleenex. These were bits that were donated from some people as well. Kleenex, hand sanitizer, and cough sweets. Wrapped, little bow, in a box. And the box has a marker pen. It's got a couple snacks in case people who are sleeping rough get a little bit hungry, because everyone gets a little bit hungry, you know what I mean? These little disposable toothbrushes, all that stuff. Yeah. So it was really rainy though. I was about 2.5 hours out walking. And my back was hurting. You know, us guys, when we sit at our desk, you know. But I don't know. I felt really motivated, and I just walked straight, no sound, nothing, for 2 hours, 2.5 hours or so. And I found a couple of people, and it was nice seeing their reaction and all that, which was cool. But yeah, I'm going to do that for the next couple of days as well. I had a test as well this morning. Yo, efficient trough. You know what, yeah? I'm going to put it right there to you. The fact that you're looking to get involved in trading at such a young age is amazing, right? Trading, investment, whatever. This is a very difficult area. And the reason why I can say that, start the earlier the better, is I opened my first investment account back in 2013. And I may look quite old, but I'm actually 18. So when I opened that first account, that was in small cap equities. And obviously I couldn't open it under my name because, you know, I was 11. And the money I'd made was from buying and selling glow sticks and furniture, gold and silver bullion, game accounts, whatever. And I just thought, let me try it. I always wanted to be involved in this stuff. And my first trade did well. Second trade almost blew my entire account. And since then, I've been slowly trying to focus on growing. I developed a proper strategy about 3 years in. And that's where I started looking at quantitative things. If you guys were here from the beginning of the stream, you'd have remembered a lot of stats that we talked about to do with seasonality, anything to the financial situation of these companies, relative valuation, blended forward, price earnings ratio. All these little bits are what actually gets used by industry and investors who really make money. Those who purely use TA, unless you're trading crypto or something, which I don't personally trade, or foreign exchange, which I don't personally trade. Most of my focus is in equities, stocks, that kind of thing. Unless you're doing those, then you have to have some form of fundamental understanding. And that can't be from the news. You can't just watch the news and be like, yeah, stocks are going up because of stimulus. Ironically, you probably would have made a lot of money recently if that was your trading strategy. But it just doesn't make sense, because in the long run, stimulus doesn't happen every single day, week, year even, or sometimes, especially in recent years. But nonetheless, we've started this 10K portfolio to purely show how trading really looks like. It's not, hey, I'm trading every single day, I'm up, and then I'm down a little bit, then I'm up. No, you have bad days. Look, the fact that on AO World, for example, yesterday's position that I got out of, and the video will be out probably tomorrow or so, you can see that even though I made money, I've been holding this for about 2 weeks. I got out right at the lows versus today and yesterday. You see that? So I'd have made a lot more money. But there are days where things get super ugly. So far on this 10K series, you guys haven't seen that. I've been working on reducing my drawdowns severely over the past couple of years, so you can see why there's less frequency of trades. But when I'm right enough. When I'm wrong very small. Like, let's look at losing trade, £45, and there was another one as well. Can't seem to find it. Oh, appreciate the support on the channel as well. Let me look through the chat real quick. Alright, so S&P 500, I think that will drop looking at TNFA. I remembered that I had to be doing something. 20 QB. Alright, I'll push this on a little bit longer. I'm looking into it for like 6 months. Next month, so still learning. Efficient trough. The fact that you're working on it already is very commendable. People were laughing at me when I was looking at like graphs and financial statements and all those news bits and making podcast episodes and stuff as a kid. But you know, you don't do it for attention. You don't do it for society's approval. You do it to do something you love. And that's what it's all about. Happy New Year to you, Andre, my brother. Yeah, a win is a win. Indeed it is. Okay. 7.7% is fantastic for a month. I think it's about a month and a half. Let's see. This would have been the first trade. Yeah, about a month and a half. That's alright. It's okay. It would have been 10% if I made that bad. If I didn't make that bad trade yesterday. And probably will be 12%, but it's okay. We're all good. Nonetheless, I've just seen very volatile week in terms of fundamentals. Yeah, crazy. I come back from the walk earlier and I see Alibaba up 5% just because Jack Ma's not missing. Just because he's not missing, that's not good news. He's laying low. If he's laying low, that means that he's restricted in some capacity. He was a very loud person. He was kind of Elon Musk-esque. Very different people. But they were really publicly outspoken guys. And for one of them to go quiet because of some falling out with the government is worrying. I feel like Interpol's head guy had a bad ending. I hope obviously Jack Ma's alright, but we must be very careful. So on Twitter, all for a good cause. Yeah, man. I wish I could turn the laptop and show and the monitors, but this is one example of the stuff. And we've got blankets, proper blankets that literally, when I was going earlier and we were distributing the first set, I was just walking with them under each arm, and I was getting all sorts of people staring at me because it was raining and I was carrying 2 big blankets and in a rucksack. It looked like I was going to use it, you know, and sleep somewhere. But the fact that that could even come by someone's mind, and the fact that that could even happen. I was out there with gloves and I was freezing. My hands were super, super cold. The fact that somebody out there is sleeping unsettles me in that kind of weather, in those conditions. And I found a couple of people. There weren't as many as before. This is London. This is central London, right by Bank Station, right by St. Paul's Cathedral, by Lloyd's Bank, all these hedge fund places as well. But you see people still sleeping underneath like little bridge intersections. There was a guy who was asleep and he just had like a thin blanket over him. It's a tough world out there, man. A lot of people, I've just seen that compounding will make the portfolio look hotter than Margot Robbie by the end of the year. Oh la la. She is a very beautiful lady indeed. I did like The Wolf of Wall Street. Not just because she was in it. Well, actually, I didn't really like the movie that much, but she had some good acting. But anyways, let's see. Best thing you can give yourself is time to learn and time to make mistakes. Yeah, I make mistakes on a regular. If there's one day where I don't make a mistake, that's very odd. I'll give you an example, right? Say I've got a list of things I would to day trade, right? I'd be like, okay, I'm going to go long on this if this happens, short on this if this happens, kind of thing. And most of those setups do work out, but I don't execute them. And sometimes I should have executed them, but I'm trying to reduce my frequency, improve my quality. That's the main part of my process that has always kind of been changing. Let's see. Big up Gabrielle Christek. Respect to yourself. It's okay though. Wow. Do you know what's cool though? We raised roughly what we're up on this 10K portfolio from just people in the community, students, all that stuff in 2 days. So big respect. Big respect to people like Gregoire Dupont. Really, really nice guy and a very humble person in the trading community. He also does these like free webinars and stuff. Super cool guy. He low-key just donated a nice, impressive amount of money. Also, respect to some of the people I work with as well. And the random people I've never met in my life that were still willing to support a cause, which is real nice. Motivates you to get up in the morning. Okay, Jump US 30 says, I'm 22, I've been trading for 2 years and still not profitable. Well, Jump US 30, let's try and talk about it. What do you think is the main reason why you're losing money? It doesn't happen overnight to make yourself profitable. I haven't had a bad year, but I've had very, very bad losses at times. So whilst I've been profitable for every full year that's gone by so far in my trading, I think the first couple of years were luck. So I count them as losing years. And you know, if I blew up, had I have continued, I don't know, I got close to blowing up a couple of times. I remember I was literally trading a stock day in, day out, one small cap, one like penny stock, just to regain the 40% loss I'd made in it. And I became like enthused with it. You should never get attracted to one stock, attached to one stock. But I got super attached to the point where I knew the company better than the managers. Like I remember I went to one of these conferences and they said, you know, this is even like not useful. And whilst that was open information, I just thought, wow, that is some rubbish management. And I think I cut like at a loss of 5-6% after trying to trade that money back. Let's see. Efficient Truff says, yesterday I was watching crude oil and I saw a strategy and I was right because it went from 47.27 to 50.12 and I was happy. I don't know if it means a lot, but yeah. That's exactly the mistake almost everyone makes. You'd be surprised, right? You're right. And it went in that direction. But why? Why did you expect it to? Ask yourself, other than looking at a graph and saying, oh, this looks like it's going up, I'm going to buy it. This looks like it's going down, I'm going to sell. Or maybe even go short and look, boom, you'd have lost. Oh no, it's going higher, let me close my short. Boom, let me buy back some shares on this drop. Oh no, it's falling, close those longs, go short. You see that cycle? You lose money from just trying to be right. You don't have to be right. When I began trading, I was right like 86-87% of the time. But I wasn't making enough money. I was having one loss that would cover maybe 5 or 6 good trades. So that one loss would wipe out all that hard work. Now it's obviously different, but now, ironically, I'm right near to 50% of the time. Whilst most of the calls I seem to make on the stream are right, I'm actually less right than you think. But when I make the move, I make the decent probability situation in line with my quantitative strategy. That part I call my secret sauce that I can't disclose. But also fundamental factors, technical factors, all those bits. Play the game and then create value. That's what it's all about. And what I do is, as I grow my portfolio over time, I make investments in companies that I believe are high quality and meet my specific criterion, investing criterion, that is. And that seems to be how I think I've been able to continue growing, because you make trading income, but that's not every day, but it's infrequent. And then you have those longer term kind of, let's say, a month and a half, 2-3 month holdings that you can catch the meat of a move and really grow your portfolio. That seems to be how most can do well as well. Trading is all risk management, says Vijay Sharma. I could not agree more. That is totally what trading is. Trading is risk management. In fact, when someone asked me the other day, how do I start trading and all that? I'm like, read up on risk management. That's it. You shouldn't waste your time anymore. just do that. I'm just catching up with chat. I think there's a lot more going on today. Let me just see. GMS says, that's amazing. Appreciate you, brother. Vijay Sharma says, Federal Reserve actually has a document outlining how to manage your risk as institutions. Well, if that's out there, traders should probably read that too. Focus on minimizing your risk and profits follow. What's his name? It's Pitbull, that's it. They sometimes call him Chico. Pitbull said that if you're chasing money, it runs. But if you're making money, that's different. I don't actually know what that means. But the way he said if you're chasing money, it runs, I associated that with it. If you're chasing a trade and you lose money or you make money and then you want to consistently trade that stock, then it will run away from you. You'll burn yourself, essentially. Javon Jump US 30 said, bad entries. In what way are you classifying it as a bad entry? Are you just entering for some random reason? Are you literally going on Google and saying, Amazon, actually, forget that, Tesla stock price, and then being like, yep, I'm going to buy these guys. Well, you would have made money. Oh, okay, that's rising a lot. Let me just short. This is not how we can trade. Also, ironically speaking, Tesla, I still see bullish signals, not from this, but actually from the chart. We were looking at it in the last stream, and I'm trying to find a point where I can short. I know that's weird, because in 4 years, I haven't even thought about it. But this is a short for a trade. Obviously not as in saying it's worthless at all. I just think it could be overvalued, interim wise. And then when you have that index correction, this is that thing that somewhat moves. But that's just a preliminary idea. I assume it will base here, break out again, then what? I need to do an equality projection, but I think when I did it last time, it was like 830, 840, something like that. And then, 10% risk, 20% raw, 30% raw. And the probability is overwhelmingly in the downside at that point. But for now, it's probably still a long, ironically. But Javon Trading says, I'm just happy to be year. I'm assuming that's up the year. Oh, here. Oh, appreciate you soaking up all this information. If this coronavirus taught us anything, it is the importance of self-sufficiency, and jobs don't care about us at all. I agree with you. I've personally had family that have worked in places that they thought were totally safe, and friends as well. And I mean, I was working in a restaurant to save up some things for some other passion projects without having to take money from my investments. But now I work at a consultancy, which is a weird kind of transition, but obviously one must be grateful nonetheless. But those restaurant jobs, I was working 2 restaurant jobs, working 3 full days a week, bussing tables, working in the kitchen, all that stuff. And because of COVID and the lockdowns, they're no longer open. I can't imagine how tough it is for those who run that business, though. And yeah, the beauty of investment and trading as well, different areas, is that you have that freedom. It's not easy money by any means. It's probably the hardest money you'll ever get if you get that money in the end. Welcome Trading View, big respect. Nice to see Andre as well. Yo. It's all about how the win percentage relates to the average win to average loss ratio. SCHEP says, What are your thoughts on the UK 100? I don't understand why it's lagging all the other indexes like the Dow. You know what? That's actually interesting because I grew up on this market and I'm quite familiar with most of the stocks. I mean, let me just pull up. Today the FTSE's up, so I'm going to pull up on my other screen an interesting set. The main reason why the FTSE is lagging is because our only near kind of tech companies are literally Ocado, that's Octo. Oh, let me get that pie out the way. Octo, which is worth 17 billion. So not making money, but what tech company is making money these days? But look at that. 10x since pre-COVID. No, double since pre-COVID. 10x in about 2 years, I think. Yeah. That's one of the only kind of tech companies. But then you guys have in the US things like Tesla and all that have done really well. Even Peloton worth $45 billion. How can an interactive treadmill company be worth $45 billion and then not making money as far as I'm aware? Correct me if I'm wrong. That shocks me. I think the reason I mentioned this, I should probably explain the theory behind it. The sector makeups are what matters. You see, China's MSCI ETF, if I pull it up, China MSCI ETF. This is the Morgan Stanley Capital International ETF. If you look at what the large proportion of this ETF is, you'll probably see Alibaba, Tencent. That's my bet. I'm pretty sure. I've probably seen it before. Alibaba, Tencent, all that. And these companies are kind of tech related to a degree. JD.com, Pinduoduo as well. Xiaomi, the phone, but that doesn't really stand out as tech in that way. Pinduoduo, that's it. Baidu, all these guys. So when we look across different country representative ETFs, the UK's got a large amount of oil and gas, E&P and all that, which doesn't help considering the energy sector's been lagging for such a long time. I want to pull up some of the constituents and divide them by group because I have an old bit on the left screen as well. Let's see how I can do this. You guys can see the screen, but I'm doing something on the other real quick. I think the only growing industry we have that kind of stands out is like fast fashion, Boohoo, Next, ASOS, etc. But those companies are worth like 2-3 billion a pop. Tesla, what was it? 2% of the S&P or something. I don't know. No, it's not that. Actually, I think it's more, but I don't remember the exact stuff. But just 600 billion, 2 and 3 billion. Do you see what I mean? The UK just can't catch up. We need a new sector. I mean, other large companies. The only other one in terms of large constituents that I can see are pharmaceutical companies, AstraZeneca, etc. But they're still nowhere near these guys, the tech ones. And let's probably look at some other ETFs. See if we can list them over. Okay, Europe. One weird one, Greece. That's a real weird one. What's another one? Italy. I want to see why the UK is lagging Italy and stuff. I'm not sure. I think inflation may be something that comes into play, but then no, I would actually disagree. I don't know when it comes to these guys. Let me see around. Pretty sure I've got UK Financials Investment Trust. That's the American one. There's a lot of stuff going on here. Asia Pac. Okay, these are the countries. You see Thailand and stuff are still lower. Thailand, Singapore, despite they're higher from the COVID kind of March first lockdown lows, they're lower a little bit. Malaysia, it's interesting how they're mid. But Israel's more techie. I guess anything that's got a higher tech weighting seems to be moving in that way. Hong Kong, China large cap, obviously higher because of its huge tech kind of makeup. Saudi Arabia, I assume it's oil dominant economy. They've got Aramco as their largest company. Pakistan, lower. I assume not much tech valuation. Vietnam, I have no idea about that one. But the overall kind of theme is that. That's what I'm trying to say. I have the data somewhere, but I have to show it another time. I don't understand why it's lagging all the other indexes. Yeah, I'm not really sure. I don't know why the Nikkei's on fire. I mean, tech, but S&P, tech, Dow, not so much, but still. Who knows? SCHEP is the chart god. The OG. The original bag holder of Twitter. Vijay Sharma says, yeah, Google Federal Reserve Overview Risk Management. Okay, one sec. Alright. At Quantium Research says, jump US 30. Also, I'm pretty sure I'm live on YouTube. Alright. Let's double check. Yeah. So, next chat is back to TradingView. Jump US 30 says, sometimes I will get a good trade and bad trades. But what is your system? What is your strategy? Do you have something on paper at the very minimum? If you're not a spreadsheet nerd like I am, if you have something that you can put on paper right in front of you, do you have something to pull up to say why you're investing in something or trading? And if not, I would wait before creating another trade. Also, I'm going to put up a Google Sheets engineered spreadsheet. There was, what was it? There we go. I'm gonna pull up some interesting data, maybe look around some stuff with you guys. I still haven't done my yearly screen, that's why I'm kind of new to, whilst these are new lists that I've added, I think there's at least 8 sets. UK REITs, tech, ETFs, SPDR sectors, extras. This one's a cool one. Energy. Look at that energy breakout. It's trying to retake those desk levels. TLT is the bond ETF. That's for 20 years. 1 to 3 years, so shorter term. I think that's intermediate term, I would say. GLD gold. Gold's powering through. Real estate, sticky. Healthcare powering through. Vaccine rollout phase. Actually has some form of alignment. Utilities. We've got consumer staples. Commodities, which are ripping. Normally commodities break out pre-recession, seasonally. But then again, they did pre this one. And this is just recovery. You almost always see recovery to base and then higher before cooling down. And it doesn't cool down yet. It cools down on the next leg normally. Let me see my spreadsheet. Okay. I've got some asset class returns to 2016. Let me pull it up. Okay. I want to pull up this super cool spreadsheet. All right, boom. When you're looking at investments, right, you should first look at returns of those asset classes over the years to first try and understand how they behave. So we've got some representative samples. Don't worry too much about where they're from up to 2016. I need to update it and make it a little bit nicer, but for some reason it's broken here. I'll fix that another time. But nonetheless, we've got real estate investment trusts. So you can see from 1972 all the way here. Look at that. The biggest down year, aka the maximum drawdown, was in 2008. That was the financial crisis. 37.05% in 1 year. That was actually not the biggest drawdown. That was the return. So the drawdown must have been a little bit higher. Drawdown is difference between starting level and lowest level. Well, actually, max drawdown is peak to low kind of thing. You can see the average return from 2010, which was just after the crisis in 2008 was over, but also a year after we had like a huge bounce, and then we could get back to some form of normalized average, the level of normalization, basically. That 2010 to 2016 average was 13.9% a year for real estate investment trusts. Considering the average market return is normally 8% on a 100-year sample, this is much higher than that. And why? Because we've excluded the 2008 crisis and also a drop here in 2007 as well, by the looks of things. Now, if you're buying coming out of a recession, you're likely to make at least those 8% gains in these areas if you're investing in things like US real estate, UK real estate as well. I mean, we have a clear example with the real estate investment trust that we pulled up. This includes... This includes the UK housing real estate investment trust that I showed. These ones over the years, let's just look at a month candle and we'll go back to 2010. Okay, this is obviously crisis territory. £5.44 to 37 pence. Really? Wow, they must have been small. Recovery to 312. Down to 160, and then what is it at the highs? 10 times more. Compounded returns at 13% a year for 10 years gives you that kind of thing. And you'd think it's not 10% a year for 13% a year for 10 years. You don't get the same amount each year, obviously, but let's just say you assume it on a simple interest basis. You'd think 100, 10 times 13, but it's not really that. It's whatever you had times 1.13. Next year times 1.13 of that amount that's been accumulated plus the interest, and it gets larger and larger, and you could find yourself, instead of maybe doubling, going 4, 5, 6, 7, 8 times in an investment just by holding. Sometimes it pays to be a bag holder is my main point, and that's what investing generally requires you to do. Be patient. Let's check if this is still working here. Alright, so back to the spreadsheet. Boom, look at this beautiful set of returns. Asset class returns. This is to 2016, remember. And I have a little average that I just compiled. Nothing special. So, let's look at Sweden. 8% average for 2010 to 2016. But the largest losing year was 2008. They also had 3 consecutive down years. 2002, I believe. No, 2000, 2001, and 2002. 22%, 23% down, 29% down. That is ugly. In those years alone, you'd probably have a 60, 70% drawdown. Year after, 67% return. So, you got to know the type of asset you're investing in. Gold is somewhere nearby here. Here it is. So, with gold, 1973, 48%. 1974, 72%. You see these. Let's see another big thing that stands out. Really nothing beyond 2007. Crisis times. You had gold increase 30%, then 5% the year after, 23% the year after. With the market recovering, gold would increase as the market was falling, and it would still increase as the market was rising. 2013 was an odd year for that. So you have to position yourself accordingly to where you believe the next direction of the overall trend in your given index is, or just the global market as a whole. But you can't say stocks are going to crash everywhere, because if you say that, generally there are inverse correlations. Some countries, when generally stocks are down, some indexes tend to stand out. Think of China. China's interest rate is 3.85%. As far as I'm aware from the last time I checked, it could be 3.65 if they cut it. And most countries in the world that are developed to the size that they are an emerging market by definition, but by size, they are definitely going close into a developing market kind of territory. Now, most countries have near, say, sub 1% interest rates, if not negative, including European Central Bank and friends. Now, with those super low interest rates, the whole picture of things change. You can't just cut interest rates to stimulate economic growth, keep the markets growing. You have to print more money, or essentially create credit, which is quantitative easing. If you've heard QE 1, 2, 3, where are we at with QE? So much that they probably stopped calling it QE. But in China, they have room to cut the interest rate versus anywhere else and still continue to grow. And they may be able to maintain above 6% growth for the next couple of years. In COVID, they got 6% growth with a 3-month hit. Well, we don't know how they'll do in the future, but they have more power versus most other developed nations. So if you believe that global stocks are generally going to suffer, they may be that silver lining. If anything is going to stand out, it would probably be Chinese stocks versus anything else, at least. It is not a series where everything goes down at the same time. Some things go down, some things go up. You mustn't get attached to either being bullish or bearish. You got to be able to play the game. Efficient Trough 78508 says, so if I should not look at patterns, what should I look? I think you should look at patterns, but you should look at financial information too. If you're looking to get started, there's a couple of videos that I've made along with the Quantium Research team. These are real life examples from the financial markets of chart formations in action. That might be a good way to start. I wouldn't look at hype stocks like NIO and all that. I would start from the bottom. Also, if you're thinking, okay, yeah, I learned a bit of charts and all that, we've also released some stuff where we walk through fundamental analysis. So the main 3 statements. For some reason, the income statement one isn't up there. But look, cash flow statements should be somewhere there. Cash flow statements. Balance sheets. It's not too complicated at all. And we'll make sub-series in the future as well for those. I'm going to share that link in a chat in case peeps want to check it out. In the meantime, I think we're going to end this stream for now. We've had a decent amount of research, and I appreciate all you guys for tuning in. Oh, trading views followed. Living life. Big up yourself. One of the elite few. That's cool. Jump US 30. Keep in touch. And we want to hear more about your journey as you progress. I thought I knew a bit about stocks, but when I'm listening to you, Dan. Nah. Everyone looks at everything differently. But all I would say is, it's not that I'm overcomplicating things. It's just you have to think differently if you want to achieve returns that are above what the general market's getting. You have to not get attached to stocks like most people do. If you talk to people about stocks, they'll be like Tesla. What else? It's not just Tesla. It's, okay, if you look at that whole sector, divide it into all the companies involved, different nations, all that stuff. Look at this. And look at the companies. The companies can be made into small batches of things called ETFs. So European ETFs, this represents Turkey's entire stock market. It has all the good stuff, but it also has all the crap. But here's the thing. If you want to see roughly how the market's doing, get involved in monitoring these. Russia, Poland, Portugal, Switzerland, Germany, UK. Ooh, that's what we were looking for, actually. Check that on a daily before I head off. Okay. We seem to be breaking out in terms of an ETF stance. I think, really, the government hasn't put in enough support in terms of stimulus and all that like the US has. Obviously, they're trying to not get inflation, but also not deflation in the activities they're doing. But I think they'll eventually give up. The way global stock markets are recovering, only a little bit of support's needed from the UK government, and then boom. Even though the whole retail sector's dead, and yet the stocks are rising. That's a way to end this session on. But I appreciate everybody for coming through. I appreciate all the kind words. And also, once again, thank you to everybody who helped out in the fundraiser. Current status of the 10K PF is 10,760. I've been too focused on my other portfolios instead of focusing on streams, which kind of made me make a rash decision. Only because I held AO World on my other account. I thought, yeah, I can close here, reduce my exposure. But it doesn't make sense in this context. But hey, it is what it is. Been a pleasure. Thank you guys for coming along. I've been Ryan Kia of quantiumresearch.co.uk. And as always, we shall see you next time. Peace.